Something major just changed in the American banking system, and if you are retired or receiving Social Security benefits, this affects you directly. This is not a drill, and it is not something you can afford to ignore or push to the back of your mind. A new banking rule has quietly gone into effect, and millions of retirees across the country have no idea it exists. That is a problem because not knowing about this rule could cost you money, delay your payments, or leave you locked out of your own account at the worst possible time. We are going to break this down carefully and clearly because you deserve to understand exactly what is happening, why it matters, and what you need to do to protect yourself before this catches you off guard. Let us start with what changed and why the timing matters so much right now. Federal regulators have updated compliance requirements that directly affect how banks handle accounts tied to government benefit deposits, including Social Security retirement payments, SSI, SSDI, and other federal income streams. Banks are now under stricter obligations to monitor, flag, and in some cases freeze or restrict accounts that fall under certain activity patterns. The intention behind the rule, at least on paper, is to reduce fraud and protect vulnerable account holders. But the real-world effect for millions of retirees is something the fine print does not warn you about clearly enough. Here is where it gets serious. The new rule gives banks broader authority to place temporary holds on accounts, delay the release of deposited funds, and request additional identity verification from account holders, even if your account has been open for decades and you have never had a single problem. That word temporary is doing a lot of work in that sentence, because for a retiree living on a fixed income, even a 24 to 72-hour delay in accessing your Social Security deposit is not a minor inconvenience. It can mean not being able to pay a bill on time, missing a prescription refill, or falling short on rent or utilities. It can cascade fast. What makes this particularly frustrating is that many seniors will not receive any clear advance warning from their banks. The new compliance framework does not require proactive outreach to existing customers. That means your bank may already be operating under these new rules, and you are only going to find out when something goes wrong. Now let us talk about what specifically triggers these new account restrictions, because this is the part most people are not hearing anywhere else. Banks are now flagging accounts that show patterns considered statistically unusual for fixed income recipients. This includes sudden changes in direct deposit amounts, multiple small withdrawals in a short window, new payees added to automatic payments, changes to contact information or mailing address, and even the absence of regular transaction activity for a period of time. If you have been consolidating your finances, helping a family member, changing your phone number, or if there was any kind of disruption to your normal routine, your account could be quietly flagged for review without anyone telling you. Here is why that matters on a deeper level. When a bank flags an account under these new rules, they are not required to notify you immediately. In some cases, the review process runs in the background for days before you ever see an impact. The first sign you might have is your debit card declining at the pharmacy or your rent autopay bouncing. That is an awful way to find out there is a problem, especially when you did nothing wrong. The concern that advocacy groups for seniors have been raising is that these rules, while designed to protect people, were written without enough consideration for the realities of how retirees actually use their accounts. Retirees are more likely to have fluctuating medical expenses. They are more likely to update their contact information when they move to assisted living or a new state. They are more likely to rely on family members to help manage finances, which can look like unusual activity to an algorithm that does not understand context. And algorithms are doing a lot of the work here. The compliance systems banks are using to enforce these new rules are largely automated. There is no human sitting there looking at your 30-year banking history and saying, "This person is fine." A machine flags the pattern and the process begins. That is the reality of modern banking compliance. And retirees are disproportionately affected by it because their financial lives often do not fit neatly into the behavioral models these systems are built around. Let us get into what this means for your Social Security payments specifically, because this is where the stakes get highest. Your Social Security benefit is protected by federal law. The Social Security Administration deposits it directly into your account, and there are protections in place that are supposed to prevent banks from seizing or offsetting those funds for most types of debt. But here's the gap that this new rule creates. A bank placing a temporary compliance hold on your account is not the same as seizing your funds for debt collection. It is classified differently under banking law, which means those federal protections for Social Security income do not automatically block a temporary hold from happening. The bank is not taking your money. They are just preventing you from accessing it while they review. The legal distinction matters, but it does not pay your electric bill. And that is the reality gap that millions of retirees are now sitting in without realizing it. There is also a secondary concern around what happens when your bank decides it needs to verify your identity under these new compliance standards. The verification process has become more rigorous. It used to be enough to walk into a branch with your ID and confirm your social security number. Now, banks may require additional documentation, including proof of address, updated beneficiary information, or in some cases, a secondary form of identification that many older Americans simply do not have readily available, such as a passport or state-issued photo ID other than a driver's license if your license has expired. If you cannot complete the verification process quickly enough, the hold on your account can extend. And if the bank's internal review escalates, they have the right, under the new framework, to report the account to federal regulators for further review. That does not mean you are in trouble. It does not mean you have done anything wrong. But it does mean the delay gets longer, the process gets more complicated, and you are stuck in the middle of it without a clear timeline for resolution. Here is something critical you need to understand about your rights throughout this process. You have the right to request a written explanation from your bank for any hold placed on your account. You have the right to speak with a compliance officer, not just a customer service representative. You have the right to escalate a complaint to the Consumer Financial Protection Bureau if you believe your account has been restricted unfairly. And you have the right to receive your Social Security benefits through alternative means if your primary account becomes inaccessible, including through the Direct Express prepaid debit card program administered through the Treasury Department, which operates separately from your bank and is not subject to the same commercial banking compliance rules. That last point is important enough to say again. If you are receiving Social Security through a bank account and that account becomes frozen or restricted, you can contact the Social Security Administration directly and request that your payments be redirected. This process takes time, which is exactly why you want to know about it before there is a crisis, not during one. Let us walk through some practical steps you should take right now before this rule affects you personally. The first thing you want to do is contact your bank and confirm your account information is completely up to date. Your current mailing address, your current phone number, your current email if you have one. Banks are required to attempt to reach you before taking certain compliance actions, and if your contact information is outdated, that process breaks down and things can escalate faster than they should. Next, make sure your identity documents are current and accessible. If your driver's license is expired or about to expire, take care of that soon. If you do not have a current government-issued photo ID beyond a driver's license, look into what your state offers for non-driver identification. Having these documents ready and accessible means that if your bank does reach out for verification, you can respond quickly and resolve the issue before it affects your access. Third, take a look at your automatic payments and make sure they are set up in a way that reflects your current financial situation. If you have auto pays going to old accounts, old services, or amounts that have changed significantly, clean that up. Not because anything is wrong, but because inconsistencies in your payment patterns are exactly the kind of thing that these automated compliance systems are built to notice. Fourth, talk to your family members or anyone who helps you manage your finances. If someone has access to your account or helps you with transactions, make sure they understand what documentation might be needed if the bank ever reaches out for verification. A joint account holder or authorized user may be asked to participate in the verification process, and having them informed in advance saves time. Fifth, write down the direct phone numbers for your bank's customer service line, your bank's local branch, and the Social Security Administration's main line. Keep those numbers somewhere easy to find, not just in your phone, but written on paper somewhere at home. If you are locked out of your account, the first hours matter, and having those numbers at hand without needing to search for them under stress makes a real difference. Now let us talk about the broader picture, because this rule does not exist in a vacuum. It is part of a larger trend of increasing regulatory pressure on banks to monitor accounts more aggressively, and that trend is not going to reverse anytime soon. In fact, regulators have signaled that additional compliance requirements may be phased in over the next 18 to 24 months, with particular focus on accounts receiving recurring government benefit deposits. The reasoning, again, is fraud prevention. The reality is that compliant, innocent account holders, especially seniors on fixed incomes, are bearing the friction of those fraud prevention efforts. What that means for you in practical terms is that staying informed and staying proactive is not a one-time task. It is something you need to build into how you manage your finances going forward. Checking in with your bank at least once or twice a year to confirm your account is in good standing, your information is current, and there are no pending compliance flags is now a reasonable and necessary part of financial self-protection as a retiree. There is also a conversation worth having about whether keeping all of your financial eggs in one banking basket still makes sense given this new landscape. Many financial counselors who work with seniors have started recommending that retirees maintain a small, separate savings account at a second institution, specifically as a backup, in case their primary account ever becomes temporarily inaccessible. This does not need to be a large amount. Even 1 month of essential expenses held in a separate account can be the difference between a stressful inconvenience and a genuine crisis if your primary bank puts a hold on your account. The Direct Express card is also worth knowing about as a backup option even if you already have a bank account. It is a federally backed prepaid debit card that can receive Social Security and other federal benefit payments directly. It does not require a bank account, it has its own fraud protections, and it operates outside the commercial banking compliance framework we have been talking about. Signing up for it does not mean abandoning your bank account. It simply gives you an additional layer of protection and access if something goes wrong. You should also know about a little-known provision that applies specifically to Social Security recipients. Banks are prohibited from charging fees to access your Social Security funds during a reasonable period after the deposit is made, and they are prohibited from using Social Security deposits to offset most types of bank fees or negative balances. If your bank has ever quietly taken money from your Social Security deposit to cover an overdraft fee or service charge, that may be a violation of federal protections, and it is worth looking into. One of the most important things you can take away from all of this is that the financial system, for all its complexity, does have protections built in for people in your situation. But those protections only work if you know they exist and you know how to invoke them. The new banking rule we have been discussing is one of those situations where the system is technically working as designed, but the design does not fully account for the real needs of seniors living on fixed incomes. That gap is on you to close through awareness and preparation, not because the burden should be on you, but because, practically speaking, it is. There are organizations that can help if you find yourself in a difficult situation related to this rule. The Consumer Financial Protection Bureau has a senior-specific resources section and a complaint system that is taken seriously by financial institutions. Your local area agency on aging can connect you with benefits counselors who work specifically with Social Security recipients. Legal aid organizations in most states offer free assistance to low-income seniors dealing with financial disputes, including banking issues. And the Social Security Administration itself has field offices and a national helpline where you can ask questions about your payment security and options for redirecting benefits if needed. Do not wait for something to go wrong before you start building these connections. The time to learn about your options is before you need them. That is not a small thing to say. That is actually the entire difference between this rule being a major disruption in your life and it being something you navigated smoothly because you were prepared. The seniors who are going to be most affected by this change are the ones who did not know it was coming, who never updated their bank contact information, who do not have a backup financial option, and who do not know they can push back or escalate when a bank restricts their account unfairly. You are not that person. You are watching this, paying attention, and getting ready. That puts you ahead of millions of others who are going to be caught completely off guard. Take the steps. Make the calls. Update your information. Know your rights. Keep your documents current. Have a backup plan. These are not dramatic actions. They are quiet, practical moves that protect the retirement you worked your entire life to reach. And right now, in this moment where the rules have changed and most people have not caught up yet, doing these things matters more than it has in a very long time. The system is always shifting. Your job is to shift with it, stay informed, and make sure that when something changes, you are the first to know and the first to act.